What's up guys, welcome back to another video. In today's video I want to go over a really good concept that I have been using very recently, and I know it's been out there. I've watched a lot of YouTube videos on it and it all kind of sucked because I didn't find all I needed all in one video, and I had to spend a lot of times back testing and looking over the charts to see what works, what does not work. And in today's video I want to talk about power of 3 and specifically the 10 a.m. 4-hour candle open and how it kind of behaves. And from my back testing and looking over the charts, these are kind of like the patterns, you can call it, or what the 4-hour candle likes to do a lot of times. And I'll show you a lot of examples in this video, but I want to go over the basic foundation of this concept. So it's basically, I like to use this power of 3 concept, but of course use the IFG entry model to enter my trades and manage the trade whenever you get into it. It's pretty simple and it depends on person to person. And in this video I want to go over a couple of examples plus the core concept of this strategy and this concept. And in next video I want to go ahead and show you, and in next video I will make a full-on backtesting session, backtesting a full month. So stay tuned to that because I want to show you how powerful this strategy is and this concept. Once you get the hang of it and once you fully understand what it's supposed to be doing and what is it doing and how it looks like and all of that. So first of all, the 10 a.m. 4-hour candle. So when it usually opens, we have kind of, or from my what I've seen or what I've noticed is I've seen kind of like 4 scenarios. The first scenario is being an AMD accumulation manipulation to the up or down, and then a distribution to whatever side it is, right? A simple AMD, pretty simple, pretty straightforward, pretty easy setups to take, and pretty awesome and pretty rewarding. So here is the thing, guys. So when I look at a candle, at a 4-hour candle, it looks something like that, you know. And here is the candle right here, you know. Let's get rid of the line, and the background will make it green. Okay, so here's the candle. We'll make it a little bit greener than that, and here it is, right? And we'll make that black so it looks like a candle. So when I look in terms of a 4-hour candle, I am imagining something like that in my head, and you, of course, you can use indicator and whatever, but it's pretty simple. So I want, of course, to highlight something here. I want to look at the candle when it's right here, okay, and when it's right here, and when it's right there. So when the first when the candle first opened, of course, it opened something like that, right? With no wick, of course. Maybe the wick is something like that, right? And with that right here, with that manipulation down there, so I want to move him around here so you can get the idea. So when it's right there, it's something like that, right? With kind of like no wick on the top, a little of a wick on the bottom, and it just switched from bearish, from black or from red, and to green, right? And then it pumps all the way up here, and it just, of course, it goes all the way up there, right? And that's a live 4-hour candle, right? And then it kind of reverses and go back to that open, and that open is right here. So let me actually take that copy here. So that would be the open right there. So in my mind, that would go like something like that, and then maybe pumps or dumps. And when it dumps, it moves color, of course, from green to black. And that's what this concept is, or that third scenario. So this is how the candle kind of like moves in a lifetime. The fourth scenario is when the market open, or the 4-hour or when the 10 a.m. 4-hour candle open, and kind of find that open line to be a support for the price, and keeps going, kind of consolidation, and then pumps out of nowhere. And of course, as I said before, I'm combining these concepts with the help of an IFG. So I would be taking something like that. Let me change the color here, add the line. So of course, this would be kind of like a fair value gap, a bearish fair value gap that got inversed. And by this time, when you're at this point, you look at where the price kind of opened and see where we kind of manipulated and played around that open, and be like, oh yeah, this is kind of a manipulation here, and then we're gonna pump and disrespect that bearish fair value gap and maybe keep pumping here. And the third scenario is kind of the opposite of the third or the fourth scenario, which is the price or the market finding the 10 a.m. 4-hour candle to be a resistance level and then going down. And of course, finding this as your entry point, because this would be an inversion fair value gap. Same thing with all of these guys. So right here, this would be an inversion fair value gap. Right here, this would be an inversion fair value gap. And right here, this would be an inversion fair value gap. And your entry would be looking something like that, and targeting this. And same scenarios with the other cases. So enough of the concept, the foundation. I'm pretty sure a lot of you guys already know what it is. Now let's look at some examples. So here, looking at this day, so this is September 9th, which is a Monday. We want to identify where is the 10 a.m. candle. So the 10 a.m. right here, and this is the open of the 10 a.m. or actually it is right here, because since this is a bearish candle. So this would be the open of 10 a.m. 4-hour candles. So this 10 a.m. 4-hour candle. So this is the 10 a.m. 4-hour candle, and as you can see, the price kind of went down and then up. And as soon as we went up and pumped up, you can quickly identify that this was kind of like accumulation, right? And this is manipulation right here. And then where is the drawn liquidity? Drawn liquidity is lower to maybe London low, these equal lows, whatever. But where is the entry from? Here is the big fair value gap that was inversed, because clearly, guys, this was what? This was just a manipulation to the upside, and we just inverse it. So your entry would look something like that. Stop loss is kind of big because those are really big candles, but we didn't even went back to that inversion, and you would be targeting that low or London low right here, and it would get you a really good rewarding price. And I'm not just cherry picking here. We can go to a different day, maybe the next day here. Okay, so here's the next day. Where are we, or where is the 10 a.m. candle that we're looking at? Here's the 1 minute, and this is a bullish candle, so the open is at the bottom. Here's the 10 a.m. New York 4-hour candle, right? And what did we do? It's the exact same thing, guys. So even if you thought that this would be the setup here, right? Even if you thought that this would be the setup and you take a long position, you would have probably gotten break even on this trade or whatever. But this is not the concept, because we don't care about these fair value gaps, because the price opened here, the 4-hour 10 a.m. candle opened here. So I am interested about what only comes after the 10 a.m. 4-hour candle. So the price opened here. What did we do? Accumulate, manipulate, and then went up, right? But then went heavily down. Why? Because that's not the market direction going up here. Although we did have really nice equal highs up here, right? But the market decided not to go up there, and we decided to go bearish. So here's would be the bearish fair value, the bullish fair value gap that got inversed, and your entry would be something like that, and stop loss would be something like this, and targeting these equal lows or lower, that would be depending on you. It's kind of a not so good of a RR, so let's just quickly maybe find something else here. So maybe this day, what did we do this day? Let's see, what did we do? We're not cherry picking here, so where is the 10 a.m. candle? So 10 a.m. candle was here. So this is a bearish candle, so the open is from the top, right? So here is that, and we just took out sell side liquidity. Here 10 a.m. opened here, right? And what did we do? We kind of wicked down, we went up, respected, all of this is respecting bearish order flow, right? So respecting bearish order flow here, that's the fair value gap, the bearish fair value gap that was being respected, fair enough. And then we created another one here around what? Around the price, around the market open price of the 4-hour candle. So I want you to imagine this, guys. So here is the candle, and here is the wick. So when it was right here and it wicked down, the price was kind of like, or the candle was something like this. So it was like that, and then like this. And when it was up here, it was full, right? And then it went down to the open price, where it was something like that, right? And then what did we do? We kind of wicked down, we took out this sell side liquidity, so now it's bearish, right? So when it was bearish, it was right here, and then the candle went a little bit higher here to fill this fair value gap and find resistance at the open. So it went back up here again, right? And then distributed down because it gave you the entry here. So this is where your order or your entry would be. I technically do not trade that way. I don't trade in fair value gaps, so I would not have taken this trade. Maybe someone else would be like, oh, this is an inversion fair value gap to the upside, you could have taken the trade from here, right? I don't think so, because we're in still kind of around the price, the price open, the open price of that candle, and it's not really moving anywhere. We could stay consolidating, so this is not a good trade to take to the upside. So I hope that answers that question. Maybe someone has that question while I'm explaining it. So let's move forward, maybe find a different example right here. What is that? Where is 10 a.m.? 10 a.m. is right around here. So here's 10 a.m. Okay, we opened here. So what does this remind us of? We pumped, accumulated, went down. Yes, we did inverse this bullish fair value gap, and if you wanted to take that trade, it would have probably been break-even trade, because that it looks like a bullish structure all around. But I'm not saying that bullish or bearish is right in this case. But let's see what is happening. The price goes up, accumulate, goes down. So that means what? That means the price or the market is kind of indecisive, because it went up, it filled the candle, and then went back to that price point or that open of the candle, of the price candle, right? So once you're at the price level, the open level, you shouldn't be taking any trade. If, okay, let me say something here. If that pump here, continued a little bit more, and then up here in premium, you get a short position, that short would be good to what? To the open price. but you are already at the open price, so you should not be taking any short or long positions here. Okay, so the price comes down, come to the open level of the candle, kind of react from it and goes up. And what do we have here? We have bearish fair value gaps on the 2 minutes, 3 minutes, 1 minute. It's visible. You see here, we kind of disrespected that bearish order flow and then go up and pump here, right? This, guys, so your stop loss would be something like that. As you can see, this right here does not look like it's a lot, but look at how much the price went. It went $61. And your stop loss is already huge. It's $35. It's not the best risk to reward ratio, right? Anyways, I'm explaining the concept here and I'm showing you what you should be looking for when you're trading something like that. Look at the second time around when the price decided to come back to that open range or open of that candle again. So this is what I was talking about. So the price comes, accumulate, come down, find support level from the open of the 4-hour candle of the 10 a.m. 4-hour candle, push the price all the way up, take out buy side liquidity, and from up here you see all of those bullish structure getting disrespected and coming at the open price with a lot of momentum and speed. So you can literally take a trade here. Stop loss is huge. It's still huge. Honestly, stop loss should be right here for like safety reasons, right? And you can target all of this price. This is still huge trade and it worked. But the price, the stop loss to risk reward ratio and the stop loss and the actual numbers are huge. You can't even take that with 1 micro. With 1 micro, you need probably like $500 of leverage to take that with 1 micros. Probably. I'm just assuming here. I'm not trying to calculate my risk here, but it looks pretty good, looks amazing, but the actual volatility of the market that day is really bad. Let's see another trade idea. So what are we doing here? Okay, so here, where is 10 a.m? Here's 10 a.m. Here is the open price. The market pushes down all that way down here. Take sell side liquidity, go all the way up here. At this point, since all of this, and I know guys, I know what you're saying, this is a news candle, and I agree with you that might be a news candle, I'm not gonna lie, okay? But the price pushed down the price that all the way down here, and this is the exact same, like this is with the exact same exact bearish fair value gap. It's still one gap, guys. All of this is one candle, and this is one gap. So by the time we inverse it, we're back at the level where the candle, 4-hour candle opened. So you can't be really taking any trades up here, and it's not coming with a big momentum or anything just like the other trade, right? So the price comes here, we kind of consolidate around, right? And look and watch where the price is reacting. So by the time we inverse this bearish fair value gap, now this is supporting the price up. This is the price is coming back and reacting from this level and pushing the price higher. And within this level, you find a bullish fair value gap that is being respected. Okay, you find a inversion fair value gap that is also being respected, but also the same time you're still around that price range. So the price, like what happened if you're gonna take a trade right here, guys, and the price starts consolidating, and this all 4-hour candle end up to be an indecisive candle on bigger time frame. So you can't take a trade around here. Okay, so the price comes back down, it does the same thing. It leaves a bearish fair value gap, that it inverses it, and still respecting the bullish fair value gap. And by this time, you see the price is coming with big momentum candle to the upside after respecting every single thing. And by this time, you can take the decision of taking a trade right here. And as you can see, what you just caught is the distribution of the 4-hour candle. And this is exactly what we're looking for. We're looking to trade and catch the distribution of the 4-hour 10 a.m. candle. And this is what we just did, okay? Because this right here, I'm pretty sure would be a bearish fair value gap that probably supporting the price or resisting the price down on a 30-second chart, on a 15 seconds chart. And by this time, you're just broke it. If you don't want to take a trade after we broke and decided to come back to that level with a big momentum, that is totally fine. Here you go. Bullish fair value gap. Enter the trade here. Stop loss here. Take 1 to 2, 1 to 3, 1 to 4. It's up to you. Okay. So that's how you try to trade this concept. Let's go to another like trading day. Maybe I'm over exaggerating here. Maybe I'm trying to scam you or lie to you, right? That's fine. That's fine. We'll look to another trade. We'll look at another trading day, another example, try to figure it out. And it's not, let me tell you something, guys. Not every day is a trading day. For example, this day, what do I see? The market wicked down when it first, when the 4-hour candle first opened, wicked down, went up, went down, and then decided to go lower. It did not give you basically anything. It didn't give you any resistance. It didn't give you any support of the price. It didn't give you any good manipulation that you can take a setup at. So imagine that trade just went up here, went up there, and decided to give you an inversion fair value gap here, right? That would be an awesome trade idea. And by the time you get to the open level of the 4-hour candle, you can put it at break even and forget about it, right? But did not do that this day. That is totally fine. Let's go to another trading day. Okay. 10 a.m. Where's 10 a.m. at? 10 a.m. right here. So what do we do here, guys? This is exactly what we're saying and what we're looking for. The price just kept on dumping without any resistance or support of the open range, right? And then decided to reverse here. And by the time you're down here, okay, by the time you're down here, any trade long idea that you take is going to be valid. Why? Because whether you're bearish or bullish, you need to retrace at least to the 50% of the range or come back to the open range of the 4-hour 10 a.m. candle to at least retest it. Even if we're like going bearish, we need to retest it to find resistance and then go down. And look at it. It's laying perfectly right where a bearish fair value gap is. So whether you're bullish or bearish, we're going up. So just wait for my entry model. What I am looking for exactly, bearish fair value gap. Where is the disrespect? Disrespect happened on this candle. Go ahead. This is a perfect trade. Look at the stop loss, $13.50 freaking cents. By the time I reach that open range of the 4-hour 10 a.m. candle, put it at break even. Protect yourself. If you don't know the drawn liquidity, but you just caught the distribution of this 4-hour candle, so maybe take it to the next drawn liquidity, the next high, next low, and you just got yourself a 1 to 3.3. And this is what you should be trading. Let's go to another trade idea, another trading day. Maybe I'm lying to you. Maybe I'm scamming you, right? And don't believe me, guys. Just don't take my word for it. Just to go to backtesting and just backtest it. I have a 15% coupon for FX replay. If you want to use it, you will find the link down in the description below. You can use it, or you can get a free trial. I think it's 5-day free trial using my link and my code Kemo. So here's the next day, or the previous day. It's a Friday. What do we do? Okay, what do we do? Here's the open of the 4-hour 10 a.m. candle. We pumped, inversed. This is a good inversion, huh? Yes, it is. But we're close. We're around the open price. So we really can't take any trade here, right? If you go on the 30 seconds, this would be probably a fair value gap that got inversed to the downside. No problem. That's fine. No problem, guys. You missed that trade. It's no freaking problem. If you miss that trade, if you don't see any setups, any trading strategy entries that you're looking for around this price, that's fine. But I want you to look, what I want you to look is at that open range price, at that open range of that 4-hour 10 a.m. candle. Look how the price is manipulating up. And then when we went down here, we're respecting that level. We're respecting that level across the board. Okay. And even after we going down, that's even better trade for us, because we did what? We just engineered more sell side liquidity, right? We didn't even take out this low. So that's a perfect target the second time we come around. Look what the price did. If you want to take the buy position, go ahead. Go ahead. Here's the trade. Here's the market structure shift. Here's the market shifting the bearish ideas, the bearish order flow, into what? Bullish order flow. Take your trade here, and your safe target is what? Is always the open range of the 4-hour candle, because once we reach it, we don't know if we're rejecting, if we're supporting that price higher, if we're going to do dumb stuff. I don't know. Okay, so once we get here, that should be your take profit or your break even point or whatever. Okay, the price comes back down. So let me actually leave that. Come back down, retest from the inversion fair value gap, and pushes the price higher to support it. Okay, once we're in here, we're in this here at this level. We don't know if we're gonna reject from it or support the price higher and higher to this high, right? Great point, great idea. Look what the price did. Lift a bullish fair value gap. So when you're on this curve, the price is still bullish. And look what happened. Look what happened at the exact point of this inversion fair value gap. At the second time we came around and inverse it, this level is supporting the price or resisting the price down and giving us lower and lower prices at this level. If you want to take your trade from here, go ahead, but you need to cover this inversion fair value gap. For some reason, if we come back to it and retest from it, you need to cover it. If you don't want to, look at this. It's an inversion out of whatever you want. The perfect entries. After we already retested and all of that, and here's your trade, 1 to 2.11. I mean, there's nothing else, guys. Anyways, that's gonna be all the examples that I'm showing you in this video, and I promise you the next video is going to be a backtesting session, backtesting this concept, so you don't have to, basically. But if you want to take my word for it, take it. If you don't want to, don't take it. And I actually support you on not taking my words for it, and just go back test it and come back to me with results, because I actually want to back test this like for different months of the year, and just gather all the information that I can from this concept. So go ahead and back test it and come to my Discord and let me know how did you do, and the wins and the losses, your percent win rate and all of that. Let's talk about it. Okay, so that's gonna be it for today's video, guys. Thank you all so much for watching. I hope you found this video helpful, and if you did, please don't forget to leave a like on this video because it actually helps, and subscribe to the channel if you are not already yet. Thank you all so much for watching. I will see you in the next one. Peace.